Hello and welcome to this 10-minute talk episode with CM Murray, in which we will spend the next 10 minutes or so, as it says on the tin, in demystifying basis period reform and what it means for LLPs and partnerships and individual partners. I'm Zulon Begum, a partner here at CM Murray, specialising in partnership law, and I'm joined by two fantastic partnership law and taxation experts who will hopefully cut through the complexity of basis period reform for us and simplify it with practical examples and the key issues that firms should be thinking about. Firstly, I have with us Alex Conway, who is our guest contributor. He's the partner in the professional practice team at Crowe, which is a leading tax and audit firm. Alex is a chartered tax advisor and accountant specialising in professional practices and individual partner taxation, with a particular focus in the legal sector and the investment management industry. Also with us is my fellow partner at CM Murray, Corinne Staves, who is a leading partnership law expert and advises partnerships and LLPs on a range of partnership governance and transactional issues. As I said, there's been a lot of talk about basis period reform over the last year or so. It can be confusing at times, so the aim of this hopefully 10-minute talk will be to cut through some of that complexity and make it as simple as possible for people to understand and give practical examples of what firms and individuals should be thinking about and doing in order to prepare. So I'm going to start off with the first question, which is, what is basis period reform and why does it matter? And Alex, I'm going to go to you first, if that's all right.
Thank you very much, Zulon. So what is basis period reform? As I said, everyone's been talking about it maybe for the last year, but we're now live in terms of basis period reform. It commenced on the 6th of April 2023. And what, in a nutshell, it really means is that firms going forward and the individual partners will be assessed on a tax year basis. So not on when their financial year ends in the tax year, but actually on a pro rata of their profits across that tax year. Fortunately, for firms who are 31st of March year end, this has no impact because they're already on a tax year basis. But firm that doesn't have a 31st of March year end will be impacted. So just to give a very brief example on this point, if a firm has a 30th of April year end, then normally it would take 1/12 of that profit for the 30th of April for 1 year and then 11/12 for the following year. So that's in a nutshell what it means. What it will mean is there will be an acceleration of tax for a lot of people because in this transition year that we're in for 23-24, then firms are taking the combination of the old way it was done plus this new way, taking off their overlap profits if they had any in terms of it, which will mean that in the January 25 tax payment, there'll be an increased amount that is due to HMRC. And the whole purpose that HMRC is saying that this is for is in order for firms to align with making tax digital and getting prepared for it. That's been pushed back a few years at the moment from the latest bit from HMRC, but it's just getting everybody prepared for that.
And Corinne, why are firms so exercised about it, and why does it matter to us at the moment?
Thanks, Zulon. I think that firms and partners are exercised about it because they need to find more cash. It's that simple. We all know that cash is king. And in the example that Alex has just given with a firm with the 30th of April year end, they're going to have a sort of a starting point of a tax bill, which is 23 months worth of profits covered in that tax bill. Now, obviously, there are mitigations which Alex has mentioned, but as a starting point, that's really serious, and that's a serious amount of cash for partners to find. In most cases, firms reserve for tax, so partners aren't used to finding that cash themselves, and it might be that they look to the firms to help them fund that tax liability. But firms are facing increased costs and pressures on cash as clients are squeezed as well. So the real focus for firms and for partners over the next few months leading into that 2025 tax payment date will be making sure that everyone has enough cash to pay their bills.
So let's get into some of the detail of it. So Alex, what should firms and individual partners as well be doing in order to prepare for this change?
Well, very good question. And if they hopefully have already started maybe looking at some of the things they should be doing in terms of this change. But if not, now is a great time to start. But first on my kind of like checklist of what people should be doing is modelling. They should model out the impact of this change in terms of what the tax liabilities are going to be and tax payments going to be for the individual partners. So that should probably be led from a firm perspective at first. and speaking with their advisors to say, right, please can you just explain and model out for us over the next 5-year period, because that's what the profits will be spread over, this change and how it impacts us, and go from there. Once they've modelled out and they know that, they then know what potentially they need to fund. And the second stage, I would say as well, then had to start having a question with themselves, but also internally within the firm, how will that be funded? As I said, most firms hopefully will have tax reserves in place, and so they'll be able to fund this from their tax reserves. But as Corinne and you know, Zulon, firms use their tax reserves as part of their working capital. So suddenly if that moves out of the business, it has to be replaced somehow. And that's what some firms should be doing. So whether that's talking to their banks, talking to partners, various people, is how to plug that funding gap that is going on. The third step in terms of what I always think firms should be doing is think about what the administration associated with it is. This is a change of way that firms are going to have to act in terms of what they're doing with their advisors and internally. So, as I said, moving from this basis where they had to be on a tax year, there's likely to be estimates involved, and sometimes in what they're submitting. Also, much shorter timescale. A firm with a 30th of April year end used to have 20 months to submit their tax return, because they had until the 31st of January following their tax year after the financial year. Now they're going to have a lot shorter period, because basically they're going to have their profits arranged and organised in a period of less than around about 9 months in order to get to that 31st of January. So again, that timescales are shortened. So everybody has to be on top of timetables, knowing what they're doing with their advisors, and thinking it all through from that administration point. And just communication. I always emphasise communication point with their partners and internally, just to make sure everyone's aware and there's no nasty surprises that come along.
I would agree with all of that, Alex. I think that from a legal and practical perspective, how do you cope with the implications associated with those sensible steps that Alex has just outlined? For example, if you do need to look to the bank to borrow, we're hearing from our banking friends that banks are prepared to lend to the right sorts of clients that are sort of good bets. But until recently, nobody was asking the question, and really, should you be borrowing to pay a tax bill? We've seen interest rates go up. Is that a cost that the firm should be bearing? Because fundamentally, a tax liability is an individual partner's affair, not the firm's affair. And by definition, in all partnerships, you find that there are more highly compensated partners and less well compensated partners. Should the burden of the interest payment of that loan be borne equally, or should it be borne more heavily by those people who are relying on those borrowings more often? As soon as you start to sort of dig beneath the surface, there are some really tricky questions that come through. You also have to think about things like lockup. Alex quite rightly talked about trying to minimize lockup, because if you can generate cash by just getting your bills paid, then that's a fantastic way to run your business, and you should be doing that anyway. It's certainly a good way to sort of enhance your cash position. But again, some partners are really good at managing their lockup, and some are less well placed and less effective at managing their lockup. Sometimes it's to do with the type of work they do, sometimes it's attitude. Again, do firms need to change the way that they treat partners and how lockup is treated? Some firms have quite strict distribution policies that only allow distributions to partners who are on top of things like lockup and billing and WIP management and so on. Others have a much more egalitarian approach, regardless of how people are managing files. Is that still the way to go if lockup is going to have an impact on cash when there is greater constraints on cash?
And of course, some firms are also thinking about potentially changing their year-end date in order to mitigate some of the issues in the future related to basis period reform. What are your thoughts on that, on firms changing that, and what the knock-on effects could be on changing year-end dates?
Changing year-end is something that people are considering. Obviously, 31st of March is then in line with the tax year, so you're not going to bring in any of the estimates that I was talking about if you have a different year-end. However, one thing to consider really in respect of this is the knock-on effect of changing year-end, and not just from an accounting tax perspective. So a lot of firms will have holiday years tied to their year-end, which will change, and profit sharing arrangements and stuff that will change associated to that as well. And also the one thing to bear in mind is that if every single firm changes to a 31st of March year-end, there's going to be an absolute drain on and this is not just because I'm supporting my own firms, accountants and audit people all want to have their audits done at exactly the same time. which can be creating capacity constraints. So one question I would always say is ask your advisors, can they actually do the work if you did change a year end at that point in time? It may be a consideration you want to be in place. And I also think with this, there's pretty much a sliding scale. If you have a year end, a financial year that's towards the end of a tax year, you're probably more likely to change your year end because there's going to be a greater degree of estimate in terms of the figures you're submitting to HMRC than you are with someone with an early year end. So at this moment in time, I haven't seen a lot of firms with a 30th of April year end change, but I do know a lot of firms are saying, let's sit, wait and see what happens after a couple of years of going through this reform, and then we can make that decision.
I would add on the year end change that, again, it sounds simple, and actually from a legal perspective, changing your year end is a very simple step to take with Companies House, but the legal complexity is going to be difficult. For example, if you operate some kind of lockstep or some kind of non-merit based profit sharing system, that often changes. For example, people move up the lockstep at the end of the financial year. If you change your financial year, does that mean people get to move up the lockstep after 11 months, or is that not fair? And actually people should move up the lockstep after 23 months on the same step. Sort of finding a way to work that through. Does it affect things like your promotions process? Does it affect any number of things under your LLPD that could have an unintended consequence? We've seen typically that financial years of firms, that the last month is often a really good month, but if suddenly you take that last month out of account and it's a merit-based system, then people will be paid less for that particular year. Is that acceptable? Partners should be sophisticated enough to work out that money's going into the next financial year, but if the number is lower than usual, people take notice. So I think that there's a number of sort of consequences that need to be worked through, some quite difficult and some that could be very divisive. Compensation is one thing you can be guaranteed that the partners will focus on very, very closely before voting in favour of a decision like changing a year-end date.
It's always very difficult to kind of foresee the outcomes of some of those changes on especially in compensation as well, and there's often winners and losers in those kinds of scenarios. There's also firms that have quite complex international structures and again may be constrained by that. Often, say, US headquartered firms will have year-end dates 31st of December, and it's very difficult for the UK arm to change it to a different date to that. So that's another factor to consider as to impact what it could be on the international structure. Let's think about what happens if you've got to the 6th of April 2023 and you haven't done anything at all. What is the impact for, hopefully there aren't many firms in that bracket, but what is the impact for the firms that haven't actually done anything in order to prepare? Alex, why don't you take that first?
Well, first thing to say is you still have time, which is always a good thing. We're not kind of like at our year ends, as I say, it's in place, but it's only just started. So firms have time to act on this in terms of it. But one thing it is if you don't do anything, you don't change your year end, it will still happen. There will be a change for everybody onto that tax year basis. What will potentially be, if they don't do any work towards it, is that partners could have a surprisingly high tax bill, unexpected tax bill, in January 25, that suddenly they may be going, I wasn't aware of this, wasn't as sure about, how do I fund this? And that's kind of like the key kind of like question there. Also, they may not have made themselves aware of various planning points that may be available to them in respective aspects. So that's something to consider. But no matter what will happen is that in terms of when we're in this transition year for 23-24, the profits what we call the transitional profits will be spread, which is the additional profit over 5 years. So that will happen automatically to partners. Is then whether you want to make an election to accelerate those into an earlier tax period, which happens. So there'll be a bigger tax bill in January 25. It won't be the astronomical bill suddenly thinking, oh, suddenly it's there, because it will get automatically spread. But firms should do something to act for that.
So I'm going to wrap up with one final question, I think. And we're thinking into our kind of crystal balls here as to what the medium long-term effects do you think will be. How do you think things might change, Corinne, for firms and individuals?
I love these ones where you have to gaze into a crystal ball. Thank you so much. Well, I mean, the short term we've talked about in terms of finding extra cash, but looking longer term, I think that firms need to scenario plan, really, and prepare themselves for all sorts of different scenarios. For example, Alex mentioned just there that people might choose to accelerate their 5-year installments, their tax bills. And on the face of it, you'd say, why on earth would you accelerate your tax bill? And I suppose the answer to that question is, if tax rates are lower, if a government decided to lower tax rate, or there was a change of government and either there was a lowered tax rate, or indeed in the future there was going to be a higher tax rate, you can see that people would want to accelerate their tax bills. Fine, great, partners can choose to do that. But the trouble is that a lot of firms reserve for tax, and partners expect the firms to have their tax money sitting ready for them. And firms need to plan for that. Is it the case that firms are going to say, yes, if you choose to accelerate it, we will make sure there is cash? Or will firms say, if you choose to accelerate your tax bill, you have to find your own cash to pay this bill? I think LLP deeds will need to be explicit about what the outcome is there, because the last thing you want is the first people to arrive and ask for the acceleration to get it, and then the last people in the queue not to get it. That's going to cause lots of arguments among partners. Likewise, we've talked about the 5-year instalments being automatic. That only applies whilst somebody is a partner of the firm. So when somebody stops being a partner, if that 5-year period is still running, then they need to find the cash to pay the acceleration of those tax instalments. Is that the partner's problem? Is it the firm's problem? Well, on the paper, it's the partner's problem, but you can quite see a scenario where a partner says, I can't leave the firm, or probably more likely, you can't expel me from this firm, because if you do so, I'm going to be unable to pay my tax bill. So they'll either use it as a tactic to resist removal or expulsion, or if they don't use it to resist that removal action, they might use it as an opportunity to try and accelerate repayment of capital or current account balances, which might not be in the firm's contemplation. So again, explicit provisions about how that dynamic will work on exit, so it can't be exploited by disgruntled partners, is a good idea. And then finally, there could be sort of ongoing things, like if there are some partners that accelerate their tax bills and take the money out of the firm, yet others that leave their money in the firm until the end of the 5-year period, should they be paid interest on their tax reserve accounts? Usually that isn't the case. Often firms don't pay interest on any of the account balances. Some pay interest on capital. It's rare that firms pay interest on current account, capital account, and tax reserve. But maybe that will be fairer. It will be a change in policy for a lot of firms. And again, you need to change in your LLPD, but some firms might conclude that that's the way to manage it.
And I think just further on that, kind of, in terms of where we're thinking about the longer term funding, on that aspect, how partners fund that, or how a firm fund that, is actually quite important as well from a tax perspective, because as people know, if you put capital into a firm, the interest that you pay on it is relevant for tax relief. So just being wary, just to make slight changes in terms of how you do it, can actually have a better impact to you from a tax perspective. So again, it's something to be wary of. But if firms go and ask partners for capital, a partner has to be aware that that capital is at risk. If a firm suddenly has a downturn, that could suddenly be lost, and it's something they may not be willing to do or wanting to do on that aspect. And not to be the boring accountant in terms of all this, but I do think I will just make this point clear, is that one thing this whole process has been put in place is, as I mentioned at the very start, is for making tax digital. And so this is preparing people for that. Making tax digital will require firms to report on a quarterly basis in terms of their income and expenses. This is preparing them to do that, and in one way getting firms to be much more timely in their information, not only internally, but also to their partners, and then report to HMRC. That's somewhere we're going. If I was really crystal ball gazing, and I don't want to speculate this, but if you go to suddenly real-time reporting or quarterly reporting, are HMRC thinking about suddenly making a change in terms of how people pay their tax? Is that going to be something that's going to be paid on a quarterly instalment basis, or based on the bits and pieces there? And it's just something just to bear in mind, is like, is this the path that we're slowly going towards and being aware of from that aspect?
Well, thank you both for engaging in some crystal ball gazing for us. Hopefully, maybe we should revisit this in a few years' time and see what you think then. That would be really So that's it for our 10-minute talk today. Thank you very much to Alex for being our guest contributor. That was really interesting. And hopefully we can do something like this again soon. And thank you for all our listeners for listening in. Hope you found it interesting and engaging. If you have any questions that arise from this, please don't hesitate to contact any of us. We'd be delighted to chat with you. Thank you very much.